Welcome to Just Think About It with Nadine and Ben, presented by Wall Street Beats. Before we start our conversation, we have two key requests. First, if you're enjoying our podcast, please subscribe via Apple, Spotify, or your platform of choice. And second, we appreciate any kind notes as we get started and letting your friends know where to find us. Today, we're excited to kick it into high gear with Dave Dredge. David is the Chief Investment Officer for Convex Strategies, and that's a Singapore-based investment manager specializing in risk mitigation, long volatility, tail risk solutions. And David's widely considered to be one of the thought leaders in that space. Confirmation of that leadership can be found at their website, convexstrategies.com, and a review of their monthly risk updates. I call them must read for those who really want to understand risk. And David has had a front row seat for pretty much every complex economic and market event going back to the October 87 crash, actively managing risk in risk businesses for B of A, Bankers Trust, ABN AMRO, RBS, before moving to the buy side with Artrades, Fortress, City Financial, and now Convex Strategies. But first and foremost, Dave is an outspoken critic of the consensus practices of today's finance and economic standards, which I know we're going to get into, and what he dubs Sharpe World, challenging us all to just think about it. Welcome, David.
Thanks, Nadine. It's great to be with you guys. Ben, good to see you.
It's really fun because you probably know that Ben is a huge fan of yours. So I'm excited that we finally get to meet. And we're going to dive right into things first. But I do hope at some point we can circle back with you to walk through your journey from your beginnings in Utah to learning finance from our current Treasury Secretary Yellen to being at the forefront of macro risk markets in Asia during the rise of the Kerry regime. I know we could do an entire episode just on your background and experience, but I don't want to do that today. So please come back another time for that. And what I'm going to do is bring you over to Ben now, who's going to dive a little bit into how you think about things and what you do day to day.
Yeah, so thanks, David, for coming. I know it's early in Singapore. As I said, the general thesis of the show is to dig a little deeper, which I know you like to do. You seem like one of the better guests we could have on. And one of the things, if anybody reads your work or has heard you present, is that you like to do that and dig into the financial industry and the assumptions and what you term Sharpe World. So let's start off. Why don't you explain to the listeners what you mean by Sharpe World and the premises you take issue with, and why you have such disdain for the tenured professor from Stanford, William Sharpe.
I first dubbed it Sharpe World in my writings. Obviously, I'd used the term for a long time in casual conversation, but I in my September 2022 note, that again, all the notes go up on the website at convex-strategies.com. I wrote a note titled Sharpe World Closing, and in that I laid out, how I describe Sharpe World. I'll read it to you. We think of Sharpe World as a metaverse fantasy land where fiduciary wealth managers' dreams all come true. Sharpe World is to the fiduciary what Big Rock Candy Mountain is to the roaming hobo. In Sharpe World, historical volatilities and correlations always remain constant. Geometric compounding paths are irrelevant. Tails are never fat. Leverage is not risk. Frequency matters more than magnitude. Ensemble averages dominate time averages, and hens lay soft-boiled eggs. And that's my description of Sharpe World. So Sharpe World is all of the finance and economic theory that's based upon the simplistic premises of random walk and Gaussian distributions and the lie that is modern portfolio theory and efficient market hypothesis, and what my old economics professor at grad school at Berkeley, Janet Yellen, believes in terms of economic models, as opposed to the reality, which is probably better represented by chaos theory and power law distributions and self-organized criticality and punctuated equilibrium and step functions in change. And sort of my premise around what we do and how we look at the world is to try to correct for those failings and take advantage of them, because the guys providing us the asymmetric investment opportunities that we're using to construct, negatively correlating, highly asymmetric risk mitigants so that our investors, our partners, can go out and more efficiently take risk are provided by the guys who are measuring risk and accounting for risk within the Sharpe World framework. And I don't know why Sharpe World versus any other thing I could have named it, maybe because I think the Sharpe ratio is probably the single simplest example of what Nassim Taleb dubbed Wittgenstein's ruler, where
Well, isn't every distribution normal?
except in the
reality?
real world where none of them are. But it's the Wittgenstein's ruler where you've got a bad ruler, so it's the table that you're measuring is telling you more about the ruler than the ruler's telling you about the table. So anybody who's using Sharpe ratio as a ruler, where you're learning more about the person telling you that than you are about the underlying risk or investment strategy that they're talking about, because it's a complete misrepresentation. It's a completely flawed ruler.
And do you think that that's these things are so ubiquitous? Do you think it's just Pavlovian conditioning? Nadine and I, and we've talked a lot, earthquake science. Mandelbrot's been out for a long time. It's not like any of this stuff's not out there of like proper risk. I mean, everybody knows the 80-20 rule. You go on a guy in the street and he's heard of the 80-20 rule. It just doesn't work for profitability? Or what do you think it is that really keeps this as it is? And, there's a couple of us on the outside. Nassim is a very outspoken, but it doesn't, and people don't even understand the black swan, they don't even understand the human nature of that.
I go back and forth. Is it chicken or the egg, right? Did all of the academia align to the benefit of the fiduciary, or did the fiduciary take advantage of bad academic work, or the regulations that then embedded that into, embedding into most obviously BIS regulatory capital guidelines, but spread across Solvency II and insurance and IAS 19 and pension funds, and just the entire building blocks of accounting, risk, regulation, function, all in the end works to the benefit of the fiduciary and the disbenefit of the capital owner, and has been an enormous transfer of wealth to the financial fiduciary industry at the expense of what should have been compounded wealth for the end capital holder. And then just coincidentally, it turned out that in doing that, the biggest beneficiary, and Ben and I talk about this a lot, the biggest beneficiary were government bonds. And by hard coding into most particularly BIS regulatory capital guidelines that sovereign bonds are a zero RWA and can go into hold to maturity accounting and not get marked to market, and the whole premise of the 60-40 balanced investment portfolio, saying that bonds are risk reducing to a portfolio, and then taking it to the next extreme for things like risk parity and liability driven investment schemes, where levering bonds reduces even further the risk of your portfolio, which has been the path to this explosion of government debt that we've seen over the last 30, 40 years of this Sharpe World environment that really came along in the 70s and 80s, and then accentuated by the implementation of the Greenspan put across the global central banking regimes, which invented or created the negative correlation between bonds and equities through the central bank reaction function that had never existed before that time. And then you end up with this institutional holdings of this subsidized or incentivized holdings of government debt, as governments the world over now have blown through any rational levels of debt to GDP, 100% of debt to GDP across the world. And we end up now in, what everybody talks about now, in that fiscal dominance problem, where debt's gotten so big, interest rates can't go up to follow the price stability policies, what were a big part of the volatility suppression that led to the accumulation of this debt on everyone's balance sheets and in assets that have not, and I will argue from where we are now, will not create any positive, certainly any positive real compounding. And it's been an awful long time since they created positive nominal compounding. And certainly since they got to zero in interest rates, provide no portfolio benefit in people's portfolios.
So that's a good interlay. You're a big Frank Knight fan. When I was in grad school, risk just didn't seem right to me. The price movement as opposed to like what's actually risk. And he differentiated between uncertainty and risk. And then he showed but he argued that the real source of profit is irremovable uncertainty. Let's go from your standpoint. What's the most important thing in investing, risk and return? How do you define those versus how you think everyone else defines them? And then just round it off with convexity so that people can understand, the third dimension.
Yeah. So, one of my many been sick of these, but, what we call here Dredgeisms, a very famous Dredgeism, what is risk? Risk isn't what you think is going to happen. Risk is what hurts if it happens. And exactly to Ben's point about Frank Knight and, of course, my other heroes, GLS Shackle, uncertainty is the problem. And uncertainty is both the giver of opportunities and the punisher of mistakes. And in maybe the most simple fundamental flaw of Sharpe World and the world we live in is the lack of a metric for geometric compounding and the simplification to annual arithmetic means, and then the targeting through modern portfolio theory of the mean of the expected return. But it turns out it's not the mean that drives compounding through time, it's the wings. It's the magnitude, using Benoit Mandelbrot terminology. It's not the frequency of outcomes, it's the impact, it's the magnitude. And again, obviously something that Ben knows I talk about a lot, Claude Shannon, the father of information theory and information entropy. There's no information at the mean. The information is all in the tails. And the big driving in your compounding path is your performance relative to the divergences from the mean. Turns out the mean is just the average of the divergences. And optimizing to the mean, where divergences are deleterious to your performance, is factually, mathematically wrong, which has been noted. Benoit Mandelbrot wrote that a long time ago, and nobody's disagreed with him. We've just ignored him. And so our whole premise is that the way to compound is to construct your portfolio, the word that Ben used, positive convexity with convexity, such that divergences from the mean are beneficial to your compounding path. And that really turns upside down the premise of modern portfolio theory and how most investors function. And it takes into account the path through time, the time dependency of the investment path. Something that a very famous guy, Ollie Peters, is sort of the leader in terms of what he refers to as ergodicity. Investment compounding paths are not ergodic. They're not ergodic. It's not a one slice of time, 200 parallel universes. In your investment path, you will always get your own 1 percentile outcomes. And it's those 1 percentile outcomes that will truly drive the bulk of your compounding. Now, obviously, the negative percentile has a much bigger impact than the positive percentile because of the simple math of compounding. If you lose 50%, you have to make 100% just to get back to break even.
And Dave, so, one of the things that you had mentioned on a different podcast, which I think is helpful for other people to hear during the conversation, is how the industry clocks itself on an annual basis. So that in some ways makes it worse, right? Because they're thinking about, you think more, or you work toward the average if you have this static period with artificial beginnings and ends, and you're all on it to be compensated, versus thinking about that journey as you're talking over a different horizon and thinking about tails over that horizon versus the average over that time period.
Correct. And so the analogy we use all the time, and Mark Spitznagel and Nassim use it as well. Nassim and I both sort of got our brainwashing at Bankers Trust in our earliest days. And so we tend to look at the world the same way. Is the Formula One race car example, right? In a multi-lap race, the guy who wins is the guy with the best brakes. And that's because he could drive the fastest safely. But in the model of annual return, so that 40-lap race is like a 40-year compounding period. But the fiduciary, modern portfolio theory, is trying to drive the closest to the average lap speed. And then assuming that the race cars all start over equal again each lap. When the entire point of investment is that compounding pass, is the separation lap after lap after lap. It's something that I saw on your website, Nadine, which made me leap for joy. That convexity that I talk about is simply that in a race with good brakes. It's acceleration and deceleration. Are you accelerating in the good periods above the mean and decelerating in the bad periods below the mean? And over time, that's what generates the separation, and that's what Benoit Mandelbrot was working on, I believe, when he discovered the Mandelbrot set. He was focused on the infinitesimal, what we call the God particle of convexity, at the infinitesimal point between acceleration and deceleration. And that's why the Mandelbrot set shows that infinity is bigger getting smaller than it is getting bigger. Right. In Mandelbrot speech.
I played basketball in college, and for a guy who's actually getting inducted to the Hall of Fame a couple months, actually, and his philosophy was defense and limiting turnovers wins games. So basketball is not as good because the F1's great, right? Because you're optimizing between speed and slowing and to try not to crash, just like in the financial markets, right? If you hit the wall, you could die or, whatever. It's the same as going bankrupt. But maybe you could just talk with the other sports analogy, which I think is really helpful, which is the soccer pitch, especially with the Euro 2024 going on. It's timely. And talk about how the entropy and how the tails do that in that analogy for people. I think it's very useful.
Yeah, it's the same analogy, right? So we say all the time, the good old-fashioned Gaussian distribution, that nice normal curve around the mean, drawn over a football pitch, would show you that 50% of the time at the mean, the ball's in the middle of the pitch. But what happens in the middle pitch has virtually no impact on the outcome of the match. An entropy curve that shows that the value is in the wings, it's the 2 percentile of times that the ball is in the respective penalty boxes that drives all of the outcomes. It's the magnitude, the impact of what happens in the goal scoring opportunities. And so the way to win football matches is to get a really good goalkeeper and put more aggressive goal scorers on the pitch and not waste your time trying to please eyeballs by passing the ball around a lot in the middle of the pitch. And that's my great analogy for a traditional Sharpe World investment strategy that's hyper-focused on the frequency of monthly returns and is trying to please eyeballs relative to some benchmark in the middle of the pitch where they're just passing balls and creating no value. And then ignoring the downside tail, playing without a goalkeeper, driving the race without brakes, just betting that you can drive at 60% of your capacity speed and put 40% of bonds in the boot to keep you from going too fast on any curves, right? And then, in the classic, the whole premise around risk mitigation in Sharpe World is that the only way to manage risk is to reduce risk taking, right? You take capacity out of the engine and drive slowly in hopes that on some probabilistic short-term look back, you won't see any unexpected curves that you'll crash on, and you forego the upside to reduce the downside, which is, again, mathematically wrong. The whole point of efficient risk mitigation is so you can take more risk. The point of good brakes is so you can drive faster. The point of a good goalkeeper is so you can push more players forward, put more goal scorers on the pitch. Because what matters is goals for and goals against, is the separation in the pitch. I love the basketball analogy, and Ben and I are mutual friends with Chris Cole. Chris used to write his Dennis Rodman story. His equivalent of my soccer analogy was Dennis Rodman. The reason Dennis Rodman was the most important, the perfect guy to play with Michael Jordan, is because Dennis Rodman played defense and got rebounds, which meant Michael Jordan got more shots. He got to take more shots in the game. The solution wasn't to get the second best scorer on the team to share shots with Michael Jordan. The solution was to make sure Michael Jordan got more shots. And that's exactly how you should be running your investment portfolio. You should be going out explicitly creating risk mitigation that allows you to be more aggressive, to participate in that unbounded, unexpected, certain, unknowable upside of things that explode higher, not foregoing that in some game of targeting average lap speed. And I say all the time, because most people are driving without brakes, so they become suckers for the bearish siren song. So you think about all of the input, all of the research, all of the talking that gets fed to people is doomsday stories. And everybody's forever thinking the only way to solve this problem that they don't have brakes is to constantly get out of the market, or to reduce risk, or to reduce their weighting in growth stocks or whatever. And they're forever missing that uptail, which is the second biggest driver of compounding, second only to downtown. So I say all the time when I speak, one of my leading intro comments is the two biggest destroyers of compounding are, number one, bearishness, and number two, poor risk mitigation, which is the reason you're so susceptible to bearishness. If you've got really good brakes on your car, you're not scared to drive fast. If you're really good at stopping, you can ski really fast down the hill. But until you're really good at stopping, you ought to be pretty cautious going down the hill.
Did you see me skiing? I'm just kidding. No, and it relates to something else that you've talked about in the past, and that has how a lot of professional investors are trained and conditioned to try to forecast and predict, right? So if I can predict when the crash is coming, and then I can put my shorts on, or then I can get out and get in my cash bucket or whatever it is. But you take a really different stance on that. So maybe you can walk us through, for everybody, how you think about that, and why is it hard for people to understand and implement the probability versus possibility curves concept?
Yeah, one of my personal favorites of my notes I titled "The Pointlessness of Forecasting." Trying to time it, trying to get sure, you might get it right sometimes, but most of the time you don't. And you end up missing the all-important upside because you're constantly risk reducing. Far too often people think of hedging because they don't want to take risk. You don't hedge risks you don't want to take, you avoid them. You hedge risks you do want to take. You don't put a rope up a mountain because you don't want to climb it. You put a rope up a mountain because you do want to climb. And the challenge of constructing efficient hedging strategies is unique in and of itself, and has little, if anything, to do about what's going to happen in markets. It has to do with price inefficiencies in asymmetric derivative second, third, fourth order opportunities in markets.
Let's dig into that, Dave, because I think that's where maybe people get stuck, right? Is they grew up in whatever category, value investing, or a little bit of stock picking, or 60-40, or wherever they came from, right? But one of the points that you bring to light in your work is, what is a correct hedge for a multi-asset portfolio? And my simple understanding of what you have said is really to ask yourself, what's cheap now? Like, what is cheap? Instead of trying to hedge according to a view. So again, predicting, having a view. So if you buy where that convexity is cheap, that's probably not where they're valuing risk. But maybe you can walk the listeners through that concept, why you approach it that way.
Yeah, and so that's a great question, Nadine. Again, it comes back to what we talk about in terms of self-organized criticality. It's the forest fire analogy, right? We're not trying to forecast when and where lightning's going to strike. The exogenous event is unpredictable. It's the uncertainty that you're truly hedging. Now, that's represented in most people's investment portfolios, assuming somebody's running a sophisticated multi-asset investment portfolio. That uncertainty really is correlation risk, right? You've made an assumption around correlation. It's not the idiosyncratic risk of the tree that gets hit by lightning. It's the contagion risk of that fire spreading across all the other trees in the forest. And so again, this gets into self-organized criticality and what's known as percolation theory and the threshold points. And so the risk isn't the lightning strike. The risk isn't the exogenous event that we define after the fact as having caused that contagion, that reflexive risk unwind in markets. The risk was the concentrations of trees and brush that made the forest risky and susceptible and fragile, using Nassim's term, to a spark. And our jobs as hedgers of that risk are to understand the endogenous risk in the forest. Where are the most dangerous clumps of congested trees and brush that have violated the percolation threshold? Think of it as a sort of Bayesian. If there's 10 trees per square meter, there's not a lot of risk. If there's 100 trees per square meter, there's a ton of risk, because one tree catches on fire, they're all going to burn. And if this, then that becomes very much this premise of third and fourth order derivative risk or market risk, where things like, and this is really what guys like us are interested in, are volatility of volatility, right? So when we're buying, go back 3 years, when we're buying all-time cheap convexity, volatility on interest rates, right? So you go back to late 2020, first half of 2021, the only vol anybody wanted to sell was interest rate vol. And so that finds its way to us. We want to buy what's cheap. It's cheap because everybody wants to sell it. And they want to sell it eventually in forms that we want to buy it. And everybody's saying to me, Dave, why are you buying options on, European interest rates going up 250 basis points? That's never going to happen. I said, well, if you look more closely at what we're doing, we're buying options that say, if European interest rates go up 250 basis points, the all-time low of volatility will go higher.
Right.
That I'm buying volatility of volatility at zero in an environment of all-time lows of volatility, all-time lows of interest rates, all-time lows of skew, all-time lows of term structure, all-time lows and lows and lows of everything. That's a pretty good bet. That if European interest rates go from minus 50 basis points to plus 200 basis points, the volatility of volatility won't be zero. Turns out that's a pretty safe bet. And so what drives that, again, comes back to the sort of pro-cyclicality of the official risk and accounting rules and regulations that the financial industry functions under, most simply value at risk, that says the lower the volatility is, the more risk you can take. And so it's telling you that it's measuring risk as the frequency of exogenous shocks. It's saying we haven't had a lightning strike for 18 months, so the probability one is almost nothing, so it's safe to sell fire insurance, which is exactly inverse to what the actual risk is. If we haven't had a fire for a long time, we're getting closer and closer to that percolation threshold where one tree catches on fire could trigger everything. Now, of course, because the last fire was a lightning strike, everybody builds their models to look up in the sky and measure the probability based upon historical frequency, which isn't actually what probability is, but to measure that as risk, all the while ignoring the building piles of dry brush and trees right in their front yard. And then when the fire starts over on the other side of the forest because kids were playing with matches, they say, well, that's completely unpredictable. Nobody could have seen that coming, right? Meanwhile, they've got zero capital behind 99.9 times levered super senior tranches of subprime CDOs.
Yeah, and that gets back to the whole exogenous versus endogenous thing. It's, in the Sharpe World, to your point, is that we are taught that it's some exogenous outside event, in the business school. We all went to business school. That's what we were all taught, versus what you're talking about. And it continues to happen. And what other, I know in Asia, maybe you could talk about that, but and you worked at banks. How is it these structured products and some of these, carry traders, they keep going back to the well, funding with tail to buy the middle of the curve or selling these structured products. And it just, you can see over time, these opportunities continue to occur, right now, for instance.
Yeah, as Ben knows, I, quote, retired in 1999 after Deutsche Bank bought Bankers Trust, and after the the chaos that was the Asian crisis and Russia and LTCM and high yield, et cetera, because I thought that was it. They wouldn't let that happen again. That they'd go and say, hey, allowing this sort of risk to build up is far too dangerous. But then they hard-coded value at risk into Basel I and RWAs, and it got far, far worse. And the exact stuff that Nassim and I were talking to the regulators about as they were arguing about putting value at risk inside Basel I happened in GFC. And yet, because of the persistence in the world of vol suppression, financial repression, of out here pegging currencies, managing currencies, mercantilist policies, quantitative easing. So what became termed quantitative easing when Ben Bernanke started doing it has existed in the emerging markets world forever. They call it building FX reserves, right? They're just printing money and buying US Treasury bonds. And all of that led to this financial repression, suppressed low yields, which creates this incentive of savers. Asia, think of Asia as sort of the asset side of the global balance sheet. It's the savings pool to the West's debt burden. And so Asia in the early days was sort of you can argue Bankers Trust really drove the beginning of it. The creators of this yield enhanced structured investment product concept of embedding short volatility into yield enhanced investment products and monetizing this investor demand. And the regulators and monetary authorities and in their convenient handshake with the banking system, not just allow it, but continue to allow it, having to go through time after time the blow up of it, the Lehman mini bonds, and recently in Hong Kong and Korea and China, all the Chinese auto-callable and accumulator structures. And they allow it because it's the bread and butter of the banking business out here, because everybody needs yield. I mean, deposit rates have been far too low, obviously zero for the last 15 years in most of these countries, in high inflation, certainly if you measure inflation, classical terms in terms of money and credit growth, high inflation environments, high asset inflation. And so to entice people using the Sharpe World mathematics of this is a good idea, because as Nadine points out, you're defining that good idea as a probabilistic 95 percentile short time horizon. You draw a nice picture of 3 years. It's always been in this range for 3 years, and you ignore the previous year where it was outside of both ends of the range by multiples. And you ignore the wipeout effect of things because it's outside 2 standard deviations. And the participants in that food chain, either at the low knowledge end, the retail or private banking client maybe doesn't understand the risk, but really far more significant at the institutional end, is not required to account for the risk, is not required to measure risk. And as they're all fiduciaries with no skin in the game, it's not their capital that they're impairing in each of those negative compounding events. And they're able to account for the repackaged carry enhanced yield option premium as compensation linked accounting revenue, and not having to capitalize the tail risk that is outside of their 2 standard deviation faux risk measurement, whether that's the counterparty credit risk calculated as that on the complex derivative and how they're margining it, or it's the hedging risk and the sophisticated strategies around how the banks and their dealers and exotic desks are hitting F9 and going out and hedging delta and gamma and vega and volga and vanna and all the complex derivative components in these path-dependent stochastic local models that they use. But in the end, because they're not capitalizing the risk and they are accounting for revenue, I mean, think about in the banking industry, when you get a mortgage payment, you call it revenue. And you're still exposed to the insurance policy on the house. In the insurance industry, you have to put that in a pool and manage it against the future potential claims. But in banks, it's 100% revenue, each payment. So that accumulates and builds, and that creates, as Nadine was asking, this dynamic of imbalances. Obviously, if the biggest player, if the whale in a given market, if Korean pension funds are doing callable note structures, embedding short Bermudan interest rate swaptions on Korean interest rates, eventually, and not accounting for the risk, but accounting for that as enhanced income and paying bonuses on it, that's going to dwarf the demand on the other side of that. And so you'll get these massive imbalances, which then the pro-cyclicality of the risk methodology, value at risk or whatever it is, says the more they do, the lower vol goes, the more vol goes down, the more they can do, and the more they do, the lower vol goes. And right, and then you end up with these massive uncapitalized tails. Obviously, the most famous one in history, prime CDOs, where there's absolutely no capital around the assumptions of leverage and correlation embedded in those structures. And so as soon as that reverses, it's the old, again, back to self-organized criticality, what causes the avalanche? The last snowflake.
And I want to bring you to something that you often talk about, which you love, the 60-40 portfolio. And in your honor today, Dave, in your reference to Katniss in the Hunger Games, I'm wearing a very special bracelet my friend made that's called the Archer. So I wear that for you here. But, you're known for detailing here. Yeah, it's beautiful. The issues with the traditional 60-40 portfolio. So we're talking about here some problems of, I guess, like misalignment, misunderstanding. There's a lot of misses here that we're talking about in today's investing world. And you commonly ask, who's going to own the 40, right? So could you discuss in today's environment the dynamics of what you term the Hunger Games, how that fits into it? Because I think as you're talking about correlation and why people do certain things, which may or may not make sense and take the risks they do, I think that's very important to understand, because obviously people got creamed and understood correlation in 2022 between rates, short-term rates and technology and other long-duration assets. But, you could lose a couple banks last year, but when you talk to people now, I'm not quite sure that they really understand what happened, and they're still like rebalancing to that 60-40.
Yeah. Who's going to own the 40? So the 40 I'm using is in the 60-40 example of the concept that 40% in bonds in a otherwise equity-based growth portfolio is risk reducing. And that premise really encapsulates all of Sharpe World. It's the zero risk-weighted asset in banks, or it's again the liability-driven investment IAS 19 accounting standards in pension funds. It's the Solvency II that long-duration sovereign bonds get a lower risk weighting than cash for insurance companies. All of these were, I don't want to not be too harsh, they were lies or myths that incentivized financial fiduciaries, financial institutions to absorb this massive bond supply that's gone on for the last 25, 30 years. You ended up at the all-time largest amounts of debt outstanding and all-time lowest interest rates, the all-time largest holdings against this incorrect application of bad financial economic theory on people's balance sheets. And then inevitably what had to happen, interest rates had to go up. At some point, for whatever reason, the guys in charge, would decide they needed to raise interest rates. And now you have this dynamic where the unrealized losses, everybody knows, Bank of America keeps reporting their $130 billion.
Everybody loves to pick on that.
Yeah. Silicon Valley Bank went out of business. Silicon Valley Bank went out of business owning U.S. Treasuries. Yeah. Right? Think about that. A bank went bankrupt because they owned U.S. Treasuries. Right? It's madness. You had the whole LDI fiasco in the UK, where the Bank of England, just as they were trying to taper their QE, had to come in and aggressively support the bond market to keep pension funds from going bankrupt. How does a pension fund go bankrupt? Right? It's madness. And so what inevitably ended up happening is everyone took advantage of this incentive for fiduciaries, people without skin in the game, to absorb all this bond issuance. You ended up with probably the mother of all imbalances in the history of financial markets. And now you've got the mother of all unrealized losses sitting on everybody's books. And of course, in my world, that extends into derivative space, where by far the number one largest all-time ever structured product with a embedded short volatility, is a simple callable note. It's the 20-year or 2-year call. It's the 20-year, 5-year call. And every single bond that got issued had that in it in the last 5 to 10 years. And many of those, far too many of those, are not mark to market. So stuff that they changed the accounting rules so you could account to it as the duration of the call date is now the duration of the terminal date because interest rates went up. And so the challenge becomes, and this gets to my Hunger Games, as the appetite to own these bonds becomes satiated. So you see banks and central banks were by far the biggest buyers of sovereign bonds for the last decade plus, have become not buyers because the central banks are trying to taper and manage their price stability target. And the banks, as I put it, Mr. Creosote, I couldn't need another buy. I'm full. And so now it becomes a price determining factor. And the myth that this is some portfolio benefit to investors in a 60-40 type modern portfolio theory portfolio starts to get shaken. That correlation benefit goes away if the Greenspan put central bank reaction function is no longer there. Even if we now have massively high yields like 4%, not very high really. So now if there's not as many bond buyers around, and Professor Yellen in her new job as the Secretary of the Treasury wants to issue more bonds and more bonds and more bonds, this leads to what that I mentioned earlier that the official economic speak calls fiscal dominance. I call it who's going to own the 40. So who's going to buy all these bonds as every government wants to continue to finance their pet projects and energy and wars and on and on and on. And you've got this problem everywhere. And yet Professor Yellen, the keeper of the reserve currency, is going to play the role of Katniss. And she's going to get hers and will crowd out anybody and everybody that she has to. And that's a great analogy for what's gone on in the regional banking system since Silicon Valley Bank, where the Fed provided the repo facility and created an enormous incentive for non-GSIB, non-Big Six banks in the US to stop lending and just hold on to their government bonds. You're crowding out the corporate household borrowers because the banks don't want to provide credit there. You're going to, in theory, crowd out issuers all around the world. And so this crowding out effect is my Hunger Games analogy. And for now, Janet, using her as the proxy for the top of that food chain, isn't slowing down. And I've been showing recently a simple chart of the historical size of the 5-year auction in the US. And there's an obvious spike in the size of the 5-year auction back in the GFC, but that was temporary and it calmed back down again. And then there was another spike in the size of the auction in COVID, which was temporary, calmed back down again. But the current spike, which is bigger than any of the other ones, is because of the interest cost. There's no guarantee that that spike's going to be temporary.
Sure.
In fact, that spike becomes self-fulfilling, which is the whole fiscal dominance thesis, where because of the use of interest rates to manage price stability, because of the inflation created by excessive government borrowing and spending, means that the cost of paying for that accumulated stock of debt requires more issuance to fund it, which is, again, inflationary. And so you become this self-fulfilling circle where interest cost drives more borrowing and more borrowing drives interest costs. And the central banks can't raise rates enough to restabilize prices, and you break out of the faux suppressed volatility of price stability measures that we saw in sort of the post-Greenspan era and the inflation targeting era of central banks, which is the biggest anomaly in the volatility of CPI measures in the history of the world. I'd show a picture of an 800-year scattergram from the Bank of England of 20-year blocks of the mean of CPI and the volatility of CPI. And the one that stands out as the most obvious anomaly is their 20-year block from the most recent 20 years up to 2000, I think it's a 1997 to 2016. The volatility of CPI has never, ever been anywhere close to that low. Yeah. And that then drives the whole Sharpe World premise around assumptions of stable correlations and volatility. Well, that premise, you could start to argue, is going away.
You've got Katniss, right? But you also have PETA. Katniss goes with PETA. So maybe you can talk to us a little bit about what's going on in this story with PETA and there's other Katniss and Petas all over the world. I don't remember all the secondary character names in that movie.
But the District 2s and District 3s, right?
District 2, District 3, other people that get, I guess, along the way. But maybe you can talk a little bit about what happens here in the U.S., and then, we'll start to bridge that out to Japan, Eurozone, other areas. I think that would be really helpful for people to have you kind of continue that train of thought through that Hunger Games reference.
That's a great analogy, right? In the Hunger Games, everyone's supposed to be out for themselves. Yeah. But Katniss and Peeta break the rules and work as a team. And in this analogy, obviously, Jay Powell is Peeta, coincidentally a former Bankers Trust employee, a colleague of mine as well. And anybody who thinks that central banks are independent haven't been paying attention. And the whole premise of fiscal dominance means that the government has, in effect, destroyed any pretense of central bank independence. They put the central bank in a position where they must factor in the dynamic of the stock of debt, the financing cost of that debt, and the inflationary impact feed through of that debt. Now, of course, that's the same all around the world. Every currency in the world has a fiscal authority and a monetary authority. Now, obviously, the most complicated one of those is the Eurozone, where it has one monetary authority and 20 fiscal authorities, right? And a completely hopeless task of trying to balance this. And so it's almost impossible to see the distance between the ECB and the governments that they serve, where the explicit financing of the governments just became outright and continues, with a question mark whether they'll finance governments they don't like. Should be interesting to see with France. That is inevitable. It doesn't matter who the prime minister is. It doesn't matter who the president is. Again, it's the endogenous risk. Once you've broken through whatever defines that fiscal dominance tolerance, the central bank is at your mercy. And you see, really, since COVID, and this is something that my friend Russell Napier talks about a lot, since COVID, the act of stimulating, the act of incentivizing credit creation has been taken over by the fiscal authority. It got passed to the fiscal authority from the monetary authority, who'd been carrying the bulk of it. But in so doing, it's very difficult now for the central banks to wrest back control, because you've allowed them to blow through thresholds of what sustainable debt is at interest rates that call them normalized relative to inflation measures. And it's, to your point, Bank of Japan and the Ministry of Finance there might be the most interesting one, where we've now got 2 years of, the Bank of Japan injecting currency into the system, removing Japanese government bonds, only now and again as that has the inevitable impact of weakening the currency and creating a feedback loop for inflation, to have the Ministry of Finance remove Japanese currency from the system and sell U.S. treasuries. So you've got one side of the balance sheet doing QE and the other side doing QT. And it's an absolute laugh riot, embarrassment show. Now, the obvious answer, and we'll see because Ueda actually mentioned it in his last press conference, the obvious answer is the Bank of Japan needs to stop doing QE and the government needs to issue fewer bonds. And I say this all the time, Vince heard me say this 100 times. The first guy to reduce bond issuance wins.
Yeah, and we talked about that a little bit last night on Bloomberg, is that you see the percentage of corporate profits is almost all the fiscal deficit, right? So I think about it more like everyone's like, oh, it's going to be hard to cut, but it's really the credit and the equity guys are the guys who are at the most risk here, because I think governments want to be able to continue to sell bonds. I know everybody thinks it's an EM, but what do you think about that dynamic of the guys who made all the money? They're the ones with the most to lose now, and that's the kind of the calculus of, somebody's got to take the loss, right? Like this, there's no, only on Candy Rock Mountain is it all, everyone's good.
I say this all the time, again, in the sort of endogenous risk philosophy. The losses are already in the system. We're just waiting to find out how they're accounted for. Right? It's the accounting rules that are masking those losses, the unrealized losses on banks' balance sheets. We know they're there. They just don't show up in the books and records. But to your point about inflation, deflation, like everything, I'm a very yin and a yang guy. Every surplus, there's a deficit. For every asset, there's a liability. Everything has to balance. And inflation and deflation is neither per se good or bad. It's just redistributive. Inflation distributes wealth upwards and deflation distributes wealth downwards. And the owners of assets and the means of production benefit from inflation, classical inflation. I'm talking the creation of money and credit, not some narrow price measure, and it's a disbenefit to the consumer base, right? They have to pay the higher price and they don't own things that protect them from the inflation. And so to your point exactly, Ben, the fiscal largesse supported by the central bank's policies of quantitative easing and artificially low interest rates has benefited the top of the gravy train. And they're the ones who are most adamant against keeping it going, right? They're the most vocal and the most prominent day in and day out in the entire political process. The masses only get a say every 2 to 4 years when there's a vote. And that's about the only time you hear politicians, officials talking otherwise. And we're seeing that play out, obviously, this weekend in France, where the masses are saying, we don't like what's been given to us. Interesting enough to this sort of, my good friend Ben Hunt's common knowledge narrative game. The narrative of the whole media force is, again, it's like it's an exogenous event. Electing these right-leaning political parties is some sort of exogenous shock, completely ignorant to the endogenous mess that has accumulated by the guys that have been running things forever. It's always, central banks are the worst at it, right? They come out every day and tell you that by turning the knobs just right, getting exactly, in the case of the ECB, an R star that is based upon the average inflation of 20 countries, so it's wrong for every one of them, will exactly correctly lead to the future outcome they want. And yet none of the current circumstances that are so messed up have anything to do with their past policies whatsoever. We just happen to end up here, right?
Yeah.
Hey, it's crazy. I'm in a WhatsApp chat with a lot of buddies in Belgium and Germany, and they texted. They're like, "Can you believe this?" I was like, "This is what happens. It's just cause and effect. These things build up, and people will get upset." And it is the Chris Cole thing is interesting because he was the first guy really alliterated that you can transfer risk, but you can't eliminate risk. So if the central banks are going to infinite balance sheets and they keep hiding it, well, eventually it goes to the society level. And it seems that's where we're at now, right? I mean, on the other hand, the guys who are doing the opposite, China, I know you're kind of in my camp on China. Maybe you can speak to the offshore, onshore, and how you're seeing the stress that would support it getting weaker versus like Louis Vincent Gavkal saying it's going to be 6, or our buddy Rupert, who was on the show last week, he's in the 6 camp. So maybe since you're right over there, we'll talk to that a little bit.
Yeah, I'm no good at predicting. I have no view of the future, but I am a pretty good observer. I think understanding initial conditions, going to a little butterfly effect analogy, is far more important than guessing what's going to happen on some unknown future. And very few people, and central banks are the worst, have no concept around initial conditions. I made fun of the Ben Bernanke review of the Bank of England's forecasting, where he did point out that their forecasts might improve if they used as their starting base the current economic situation as opposed to the previous forecast. Yeah. Right? But in China, I can observe that they have violated, the bank PBOC has violated their own officially documented currency fixing methodology every day for over a year. So I know that's the case. It's obvious which way around that is. I don't know why they're doing it. I don't want to even assign to them reasons for doing it. I just know they've done it, and that every day they fix it much, much stronger than their own methodology says it should be. And they've done that every day to virtually the tune of their 2% daily fluctuation margins, because it trades at the extreme end of their 2% daily fluctuation margin. They've done that every day for a year. So they've fixed it artificially strong by virtually 2% a day for a year. Now, I personally think they're their own worst enemy. Why not follow your own methodology? Why are you creating this very conversation that Ben and I and Louis and Rupert are having? Why not just follow your methodology? Why not fix it relative to the day's close and the change in the basket components overnight and eliminate the speculation that something's going on? But something's obviously going on, and the demand for dollars is much higher than their price fixing would justify. And everyone's trying to take advantage of the fact that, geez, they're willing to let me get dollars. Now, obviously the capital controls, the impossible trinity of trying to control your interest rate, your currency, and have open capital markets, they can violate it in China because they have very severe extreme capital controls. Money can't freely move in and out. Now, the exception to that rule is in Hong Kong, well, offshore, but most particularly in Hong Kong, where the accumulated supply of renminbi has built and has developed an active offshore market for Chinese renminbi that operates outside of the capital control constraints of the PBOC. But it also means it operates outside the lender of last resort support of the PBOC. Now, that gets addressed by allowing one of the big four Chinese banks. In the case of Hong Kong, that's Bank of China, distinct from the People's Bank of China, a state-owned enterprise, but a private entity, can net their balance sheet onshore and offshore and acts as de facto the lender of last resort in Hong Kong for CNH, which as opposed to CNY. CNY is the onshore currency, CNH is the offshore currency. Now, there's enough osmosis through that regulatory barrier, and with Bank of China's ability to fully pass through the barrier, it keeps those two relatively well tied together normally. But increasingly, as this persistence of the onshore market trading at the limit of the 2% fluctuation band relative to the artificial manipulated fixings, the offshore market starts to diverge further and further away as the appetite, shall I say, or the available risk capacity for the arbitrageurs to try to arbitrage between the two starts to fill up, and the concerns in the offshore world of hedging that risk builds, and there's more buyers than sellers, and it starts to pull apart and starts to look like it's putting pressure on the onshore market, because the onshore, the central bank, and this is the story of capital control emerging market pegs the world over. When the central bank sees an offshore market pulling away and sees banks arbitraging, so the banks are taking advantage of the intervention of the central bank in the onshore market to buy dollars to then provide them offshore, the risk, as we saw most explicitly in Thailand in 1997, July 2nd, 1997. Interestingly, we were talking about this, July 1st, 1997 was the handover of Hong Kong to China, and the Thai baht devaluation was on July 2nd, 1997. Little karma there, maybe, we'll see. And the risk is always that the central bank says, well, I'm going to cut off the offshore market. So it's in May of 97, Bank of Thailand did that and cut off the offshore market from access to funding, the lender of last resort, from onshore banks via the Bank of Thailand and the supply of dollars, which caused an enormous liquidity squeeze and offshore implied interest rates in the FX forward markets going. I famously tell people I traded implied Thai baht interest rates at 1,000% for a 1 week FX swap. That breaks most people's stop loss limits on their $20 million spot position on an assumed 2 vol. And that's the big risk really in the offshore CNH market. And we've seen it over time. Whenever this stress builds, PBOC just has to help give Bank of China the nod to squeeze the funding cost in Hong Kong and force banks who are, need to roll short CNH position to squeeze them out of it. And so the really big risk, I would argue, in the offshore market is the implied interest rate, is the funding cost. Now, HKMA now has also built up a pool of CNH that it can use, HKMA, the Hong Kong Monetary Authority, the central bank in Hong Kong, or the branch of the PBOC in Hong Kong, depending on how you look at it, to mitigate some of that funding squeeze. But the risk of that is always out there and forever out there.
And we talked about how, a lot of people have been very confused in the West with the inverted yield curves, and you've been pretty steady about you thought they'd take the inverted yield curve right into the recession. And we're now, I have lots of buddies who have the steepener on. I'm actually long the short end a little bit, but we're not getting the steepener that people thought. What do you think about the implications of the bear steepener of the last 2 days, and maybe the fall of 22 and the fall of 23, and this bear keeps coming out to play here and there?
Yeah, I think, I've said for a long time that, because they need to protect the back end. So I said this before they started hiking rates. They need to get the curve inverted because they need people to believe the recession's coming to get them to hold on to these bonds, even as the accrual of them starts to turn negative on the inverted curve. And they've done a great job of it. I've never seen, in my short 37-year career, central banks so adamant that the recession's just around the corner. Bank of England, who's never forecast a recession in their 800-year history, has been forecasting a recession since December 2021. 2 quarters away, 2 quarters away, 2 quarters away. And all this just to get people to believe that they're standing up to their price stability mandates and that they're going to get to the recession, so hold on to those bonds. The one thing that they really cannot allow is the bear steepener. And every time the bear steepener starts to rear its ugly head, as you said, third quarter 22 and third quarter 23, you get a global narrative of pivot. The recession's coming, pivot, and everybody piles back into the story that you got to own the back end, you got to own the back end. And it's one of the things I talked about when I spoke at Jim Grant's wonderful 40th anniversary conference last year in New York. I put up a picture, a scattergram of bear steepeners through time, and there basically aren't any, doesn't exist. And so in these complex hedging models, on these stochastic path-dependent Bermudan swaption callable structures, when you're biasing your hedging, you're always biasing it towards that when interest rates go up, curves flatten, when interest rates go down, curves steepen. And so one of the sort of pockets of darkness that just doesn't exist is the bear steepener, which has implications for how things like skew and convexity and interest rate vol pricing would respond should you actually get a sustained period of bear steepening, which is, again, why it's so painful, and not least of which, of course, being, again, what I've dubbed the great stop loss. If you want to get this liquidation of these unrealized losses, and insurance companies, pension funds, banks the world over, well, the sign that that's coming is the bear steepening. And maybe, and Ben probably knows, inevitably I can't help myself, I'll write about it for my June update. Maybe my friends at Norinchukin Bank in Japan have triggered it, right? Because they've actually come out and said they're going to bite the bullet and take a massive unrealized loss on their U.S. Treasury portfolio because they don't have sticky U.S. dollar deposits. They have to swap FX deposits and short-term funded U.S. long-dated bonds, treasuries that they hold in their hold-to-maturity or available for sale portfolios, and they're getting killed on the accrual, right? Because they're eating that negative carry, whereas they do have sticky yen deposits, and you actually have a positively sloped yield curve in Japan. They're like, bugger it, we're going to eat the unrealized loss and recognize it and move stuff into stuff that will start having a positive accrual again, even as we know yen interest rates are likely to go up. So it's
the pensions don't want to eat it either, right? They're borrowing against their private equity holdings. The private equity guys don't want to take the mark because they're, they don't like taking bad marks, I guess, because then there's the follow-on effect. I mean, at least the commercial real estate guys seem to be, maybe they didn't have a choice. Maybe the bank said it was time for you.
Well, people have to hold capital against commercial real estate risk. So people, had capital, account for it, so it gets absorbed into the system. It gets accounted for. It's this other stuff that doesn't get accounted for that builds and builds and builds and builds these imbalances that, eventually lead to all of Yellowstone National Park burning down. And but to your point, why does the National Pension Service of Korea need a swap facility from the central bank in U.S. dollars? I think it probably has something to do with unrealized losses in bonds that it's hard to fund at the current mark-to-market value of the bonds in repo markets. So, the great stop loss is something to always keep in the back of your mind. Because again, risk isn't what you think is going to happen. Risk is what hurts if it happens. And that great stop loss of all these unrealized, unrecognized losses in faux accounting, risk managed, regulated financial institutions is maybe the mother of all risks out there, because that is a pain to the system. And that then comes to this, who's going to own the bonds? If these guys are selling, if Norin Chunkin, who's one of the largest global buyers of global bonds in the world, the largest in CLO markets, decides they'd rather own JGBs as a way to, they're a policy bank, not a commercial bank, as a way to support the changes in policy there, that has implications for bond markets and who's going to own the bonds.
Can I bring you to like a practitioner's execution, right? So we don't have time to go through how you figure out what's cheap, but let's say you have your convex positions, they're working, however you want to define that. How do you think about exiting them or managing them when that occurs, right? Because we've all been there where, okay, I have my risk management, it's working. When do I know what to do with it? And so you clearly have to optimize, between monetizing P&L and maintaining it through. You don't often know how long something's going to last or the magnitude of what could happen to benefit from the insurance you put on, if that's the right way to say it.
Yeah. So first and foremost, in what we do, we always have to think about everything from our investor's perspective, not from our perspective. I mean, one of the biggest mistakes people make in evaluating hedging, tail risk, long vol strategies is they, for some reason, try to look at them on a standalone basis. They try to apply Sharpe World methodology to evaluate them. They evaluate their goalkeepers on a goal scorers metric.
Versus the team.
Which is a very terrible way to go about it. So we're always thinking about, the risk that our investors are carrying, right? So they're the ones driving faster because we're providing good braking capacity. Now, the way we go about doing that ourselves, and there's a number of different ways to do it, and I'm sure Ben knows a lot of my friends that are in the business, and everyone's got a different opportunity set that they're trying to tap to make this efficient. Our simple premise is we want to own the insurance that costs the least when you don't need it and pays off the most when you do. But that one of the biggest challenges, arguably the biggest challenge, is time. Time is a very different concept in what we do. We have no time horizon like a year, a calendar year, a quarter, right? You want your insurance to be perpetual. You want the insurance on your house to always be there, to not decay to insignificance. And if you have a really good insurance provider, it grows. It grows with the value of your house. Right? So managing through time is the real complexity. And the way we go about it in terms of the monetization thing, Nadine, is we talk about layering convexity. So we try to find opportunities that allow us to enter some low convex, higher probabilistic payout trades that we can capture and monetize in less systemic dislocations, right? But use that money to allow us to build through time and reinvest in more highly convex things that are the true opportunity set to create that insurance-like payout in true systemic risk cleansing events. You don't want to be monetizing your medical insurance every time you go for a biopsy because the price goes up. You want to keep some just in case the biopsy comes back bad one time. And really, we have to suck it up and eat that. We can't be monetizing mark-to-market gains because it's good for our compensation. We have to be carrying that because of the ongoing risk that our partners are carrying on their books. A 2020 is a great example. Sure, we're going to monetize a number of the lower convex earlier layers of risk, but the really, really big potential payouts in a 3 weeks shock to the system, we're not monetizing those because none of our investors are risk reducing. They know they've got such effective insurance and they can see the remaining scale of that insurance. If anything, they're adding risk in that environment, not reducing risk. So we're not reducing insurance per se to the extent that we would, were we trying to optimize our compensation as opposed to trying to optimize their compounding. Now,
I think to go back to your analogy, you're still letting them drive fast in the car. You might be the owner of the brakes, but you're not selling the brakes. You're just you're saying, hey guys, you can keep going. In fact, you might even go faster now because we know that there's a lot of cars crashed behind us, but we're going to keep those brakes solid for you.
Correct. And then the other side of that analogy is, say, 2008, where the CLINs came. Right. And then the easy answer to the question, just like we prefer to make our investments when people, our counterparties, want to sell us attractive asymmetry, well, we prefer to monetize it when they want to buy it back. Sure. And in 2008, once they all got recapitalized under TARP and the various other bailouts around the world, they all came and bought it back. Now, prior to that, they wouldn't buy it back because they didn't have the money to pay for it. Yeah. But assuming you have good counterparty credit constructions, and we do, we're sitting on all that money in our margin account. And eventually they came and said, just tell us the price because we have to unwind all this stuff because the authorities now have said, clean it up. And that's the right time to monetize it because the entire forest is burnt and there's no more risk. So at the peak of fire insurance price, the risk is the least. At the lowest of fire insurance price, the risk is the most. And so now I've really given away the secret of how we go about it. We buy it when it's the cheapest and sell it when it's the most expensive, and then encourage our.
Is that your?
Buy low and sell high. I know it's a crazy concept, and contrary to the risk methodology.
For people emotionally.
Yeah, and then I'm a value investor, right? We spend all of our time doing nothing but tracking supply dynamics and volatility markets. And just like any other market, the value will be created by supply and demand imbalances. And those supply and demand imbalances aren't per se created by some view of the future. They're created by the accumulated endogenous risk of bad policy practices and bad risk methodologies between governments and central banks and regulators and financial institutions. And the poor disclosures that they provide to clients of theirs when they provide them these structured investment products or encourage them. The market, and you guys I'm sure hear it all the time, everybody will tell you that, in the last few years, rolling short volatility, selling S&P puts has been a great trade without ever noting that buying those same puts and owning the S&P
people have insurance in auto and home becomes a financial that's it's a waste of money. It's a waste of money.
You look at the performance of a positively convex investment portfolio and compare it to something like 60-40 or risk parity or hedge fund, whatever, and it outperforms over time always. And throughout all of the outperformance that you've had, because you're always cutting off the worst months and participating more in the best months, throughout that entire period, you always had the potential of even greater participation and the protection against even worse risks than occurred. Now, the stupidity of how we measure risk in Sharpe World is we only look at what did happen. We don't look at what could have happened. Back to what you asked earlier, again, maybe my all-time favorite piece, probability versus possibility, right? The financial world measures risk within a probability distribution. Actual risk is what resides within a possibility distribution. And
I had this talk with my kids yesterday about swimming in the ocean with sharks. It's not the probability that's going to kill you.
And which is exactly right, comes back to tacit knowledge, which I wrote about last month, and Polanyi's principles around tacit knowledge, right? Where we have skin in the game, and this really gets to Nassim's core premise, right? The key to risk, and I always say this when I speak at risk conferences, they think I'm going to disclose some secret. And my final slide is the key to risk management is accountability. It's skin in the game. Only with skin in the game, with the innate understanding that a shark could eat you, right? That tacit knowledge, will you effectively manage that fat tail downside. Right. But where you're a fiduciary and not exposed to that risk, you're happy to accommodate the world of 2 standard deviation normal distributions and pay yourself bonuses absorbing risk that never ever should have been absorbed with somebody else's money. It should be against the law, right? And then the mismeasurement, the explicit intentional mismeasurement and misrepresentation that somehow providing non-recourse leverage is a more profitable, better Sharpe ratio trade than taking on non-recourse leverage, without recognizing that the whole point of taking on non-recourse leverage is to own the risk. And if you do that, where you're always giving somebody else the worst performance and keeping for yourself the best performance, obviously you're going to compound better, right? Even if you're doing it inefficiently. This is one of the beauties of adding convexity to your portfolio. Even people who do it poorly massively outperform. And we see it time and time again with pension funds and traditional wealth managers who try to
do it too. That's the message. Even you can do it too.
Well, they try to force the justification for doing what they know is right, adding some tail risk exposure and participating in more risk. So getting out of what I call the defensive midfielders of things targeting the mean Sharpe ratio strategies. Yeah. Well, outperform. But to do that, they have to follow Sharpe World templates, at the investment committee. So they embed their tail hedge in a big group of defensive strategies and talk about the return of defensive strategies, including their bonds and hedge funds and absolute return strategies and gold, so that it has a return blended around the supposed cost of their tail risk. And they talk about it that way relative to some defensive benchmark. Not anywhere in the description do they explain the correlation benefit they're getting that's allowing them to own more assets. Right? And measuring the actual efficiency of the tail risk. What is the efficiency of that insurance cost relative to the potential protection? Everybody's always focused on masking that efficiency by somehow muting, mitigating, hiding the cost, which is the last thing you should do when you're trying to evaluate the efficacy of a tail risk.
That's good. Yeah.
What you really should be focused on is the efficacy of the asymmetry in the negatively correlating event. And yet nobody's actually doing that. And yet just by doing it even badly and poorly and underinvesting in it, the public pension fund that's done that is a superstar, right? They're the absolute superstar, and the CIO gets hired to the next great big job at some major global asset manager, right? And that's the beauty of convexity. I mean, even adding a little goalkeeping to your team is going to make a big difference. Big difference. Adding a little bit of braking capacity is going to make you a much more confident driver. Trust me. Try driving around town without brakes.
Well, Dave, I know we could spend hours with you. Thank you, sir, for sharing all of your wisdom and experiences with us today and telling us that drive fast, use your brakes, or at least know you have some good ones. Make sure you're not driving without the brakes. But if people want to know a little bit more about the brakes that you provide, how do people find you? We talked a little bit about your website, but what's the best way to reach you or at least learn about your thoughts and what you do?
Yeah, so go to convex-strategies.com. We post up on the website a portion of our investor letter that I write. We call the Risk Update monthly, and has the big picture stuff and talks a lot about imbalances and central bank narratives and portfolio construction issues. I'll link this podcast. There's a media tab that links various podcasts, interviews, stuff that got recorded. There's probably 5 years worth of stuff up there. Somewhere in our files, there's 15 years of stuff. But and there's a contact info email address there, and people are always pleasantly surprised at once my compliance has reviewed the emails, how willing I am to respond to them and share my thoughts. And we're trying to help people have a better retirement. And, if we could do that with a sovereign wealth fund, we could help an entire country. But if we have to do it one person at a time, we'll do it one person at a time and just help them understand.
Well, thanks, Dave. You're doing God's work.
It's not the lie that Sharpe World's telling you it is.
Well,
thanks for coming on.
I'd like to think so.
Thanks, buddy.
Thanks, guys.
Thank you.
Anytime.